everybody. This is Tamiya Robles. I am the owner of FixMyCreditNow850.com. I am also the president of NAREB's High Desert chapter in California. I am here with Sean Rogers, mortgage lender, amazing mortgage lender. And he is also a member of the High Desert chapter as my second VP. Welcome. Hi, we're doing yet another live. How are you doing, Sean?
Can't complain. Glad to be here. Can't complain.
So yeah, again, I apologize. We've been MIA for a bit. We're back with the jump off. Okay. We're here with it. We're gonna bombard you guys with so much information. Okay. Be sure to leave a comment. Be sure to like, share, subscribe. Check us out on our Facebook channel. We're everywhere on Facebook. Real talk. Just Google us. Just Google us. You'll find us. You'll find us on YouTube for sure, podcasting, all of that. But you got to reach out to us if you have any additional questions, comments, concerns, and what have you. If you're trying to reach Sean directly, check out the information below. You will see his contact information. So, right now, we're going to specifically talk about being denied for a mortgage. So, if you're denied, what are the next steps? Sean, can you break it down for the
I'll
people?
break it down. So, getting denied can be disheartening. Nobody likes being told no, right? However, it's all in the delivery. Usually, when there's a no, that means there's a yes. A yes can be found somewhere. If your loan officer's pretty good. He or she will instruct you how to get yourself right. Okay. So, here are the top reasons that people get denied. And I'm going to go through these so it makes sense. Number one, okay. Number one is your credit score required for the program you're trying to apply for, right? Okay. Number two is not enough income for the amount of loan you're trying to apply for. Okay. Number three could be job gap or job issues or employment issue. Those are and number four could be the type of collateral. And five could be assets, the amount of money required to buy the home. Let's go through these. All right. So let's take a look at credit score. Now remember, one good thing I would say about the credit scoring process is that it can be manipulated. There are loopy. That's why you talk to a credit advisor like Tamiya in the event I say that, hey, your score isn't high enough for the program that we have to do based upon the rest of this application. Okay. So remember, scores can always be changed and adjusted. Having a low score is kind of like getting stabbed. Right? You're going to bleed a little bit, right? But it will heal, right? As long as you're not stabbed too deep. But it will heal, right? And then number two, what did I say for number two?
Not enough income.
Not enough income. Okay, we'll edit that too. Okay. All right. Number two, not enough income. This can be tough these days. So not having enough income to qualify for the purchase price you want to qualify for. Let me give you an example. There are certain parts of the country that, if you're making what I like to call a decent livable wage, 25, 35 bucks an hour or 65 to $75,000 a year may not be enough by yourself to qualify for that home. Okay. Different ways to get around that. Right. Number one, always, I'm going to say this, don't hate me, is to try to buy a lesser house, a cheaper house. A lot of us have gotten away from the starter homes. And in some parts of the country, there are no starter homes. Right. But there are some parts of the country where you can still find a nice, decent starter home. Right. And not have to pay 4, 5, $600,000. Once again, don't come for me in the comments. There are some parts of the country that still have cheaper housing, in the low 300s, low 400s that'll still qualify. That's still decent, right? And the biggest thing that I see that I have to deny a loan for is income. Okay, right? They don't make enough money, and the biggest issue I see with that is people trying to buy homes on their own. We're not combining incomes anymore these days, right? I don't have two folks in the loan. So if two of you guys were making, 25, 35,000 a year or 25 to 35 an hour, I should say, right? And we want to buy a house, at 400, 500 grand, that may work, right? But that one person trying to buy that house on just their basic income may not be enough. right? So if we want to maximize our purchase power, which once again, I realize that everyone can do this, but it would be good if you are on the loan with somebody else. If you feel your income is not enough to support this obligation, or the loan officer tells you, hey, your income is not enough to support the obligation, right? Think about adding a co-signer or somebody to sign with you, right? For example, I read a story a few years ago. I see this. I see this a lot back in the day, where a group of we'll say 5 to 6, 25 to 26-year-old guys, they would get out of college and get a decent paying job, and they would rent a high end luxury or purchased a high end luxury vehicle, all three or four of them on the same loan, and they each share the vehicle. They get it one weekend or a week here, a week there, whatever the case may be, right? The same thing can be done with the house, right? For the homies, they're all making, you know, 50 grand a year. They get a nice house for, you know, how much ever, and they're splitting it, right? Now, once again, trying to find four friends that can do that, that you trust and want to live with, that's another story. But, right? But, end of the day, that's one way to do it. That's what a lot of families do, right? There's generations in this house. There's mom, dad, son, and maybe granddad in the house. They all go together and they have their stuff in together. Now we have over $200,000 in income for the year, and now we can afford this larger house, right? So it all depends upon, what part of the country you're in too, uh, and also depends on uh, the home prices around you. Okay, um, but once again, income is one of the biggest factors that I see. Income in comparison to the home prices that are out there. So the next one is going to be the collateral, right? The reason why the loan's being declined is the collateral. Now, the bank, the lender, isn't going to give you money for a shack. Their main concern is being able to resell that property in the event you default on the open market, right? If they're going to lend against a property that has defects, right? Health and safety issues, right? Doesn't conform to the neighborhood, right? It may be out of guideline for that particular loan you're trying to do. For example, you're trying to buy a house in a commercially zoned area with bed and breakfast at the top and maybe a storefront at the bottom, or a house at the top and a store at the bottom, whatever, right? A mixed use property that may not fly for the loan you're kind of trying to do, right? Maybe you're trying to buy a home that has a couple of homes on it already, or a lot of land that has a couple of homes on it and it doesn't qualify. There's a lot of reasons why, right? But the main thing that I see when I have to deny a loan because of the collateral is the condition of the property. Don't forget, there are loans that you can achieve that'll give you money to fix up the home and finance those funds. Okay, it's called a 2 or 3K loan or a renovation loan. Okay, they can take an extra, 25, $35,000, and they would give you that, in an escrow account at closing. Okay, you would take that money and get you a new kitchen, get you a new bathroom, some new flooring, new windows, new AC unit, right? Maybe you want to, I don't know, get new appliances for the kitchen. Maybe the kitchen that you bought was from the 1970s and it has, those old green pastel colors and you don't like it, right? You can get extra money, right, rolled into your loan basically to rehab the property after closing. Okay, keep that in mind. So if there's any issues that you see, if your loan officer's telling you, hey, this loan doesn't qualify because the shape the house is in, I got to decline your loan, right? Or fix it. And you say, I don't have the money for that. And the seller won't fix it for you. Look at a 2 or 3K or renovation loan. That may help you buy that house and get money to fix it up. Okay. The next thing that I see that you can be declined for is assets. Assets. Now here's a fact, Maya. Hear me out. I see a lot of advertisements that says no money down, nothing due at closing, or some along those lines. Right? It's not right. There's always going to be the money due either at closing or up front or mid process or something. Buying a home can be expensive, and if you can't afford it, you can't afford it. Don't force it. Okay. Trying to go into a house when you're broke, not a good idea. Not a good idea. All right. So some of the things that come up that I see, or all the things that come up that I see when it comes to buying a house and the amount of assets required that I have to decline a loan for. Number one, reserves. Okay. Sometimes the reserves. A reserve is equivalent to 1 month total housing interest, property taxes, insurances, all insurance, flood, uh, wind, hail, regular coverage, all insurances, homeowners association dues if applicable, mortgage insurance, property taxes, right? All those things are part of your housing payment. So if a lender says, hey, I want to see 1 month of reserves, they want to see 1 month of your full mortgage payment. You're not putting that money down. We just want to see it in an account that exists. So a 401k, stocks, bonds, CDs, IRAs, something that's liquid can be accessed in the event you need to access it due to an emergency. Okay. So reserves are one thing that I see that people don't have. They save up enough money to put down for the down payment, but they may not have reserves. Not everyone needs reserves. Okay. For standard loans, conventional FHA, VA reserves can help strengthen your loan file. And if you have a lower credit profile, lower credit score, okay, you may need 1, 2, 3, 6 months of reserves, right? You may need those things. You may need to have a more money to show, not put down, but show to make the loan work, depending upon what you're doing. Now, if you're doing any kind of loan like a non-qualified mortgage, like we'll say a bank statement loan, or a profit and loss statement loan, or a non-QM loan, or any kind of non-QM loan, I'm sorry, we'll need to show sometimes up to 6 to 12 months of reserves. Keep that in mind. Okay. But once again, usually I don't have to decline a loan for assets, or I knock that out in the pre-approval process and say, hey, in order for you to go under contract to get a full pre-approval from us, you've got to show this kind of money in the bank. Okay. Now, the last item that I run into, let's see, we got income, credit, collateral, and assets. That's it. Those are the main reasons why I have to deny loans. Now, quick fact here. Tamiya, take a quick guess. It's going to go back to credit. Take a quick guess on how many loans I had to deny because of a simple credit error on behalf of the buyer in
I say
2020.
about a third of your applicants.
That's right. That's right.
Okay.
So I took some facts before I get on this call. I went through my notes and I had to decline about 45 people this year for a simple credit issue. Let me tell you what that was. And it hurts my heart to say this, but it
Yeah.
happens all the time. Tamaya, you went over to Marshall's or TJ Maxx or Ross, and you saw this nice blouse. And you're like, this is a nice blouse and some boots or purse, whatever. And you stroll to the counter. The service rep says, "Hey, you can save 25% on your purchase today by getting this credit card." You're like, 25%? Run it. Let me get that 25%, right? Okay, cool. So you get your blouse, your boots, and your sweater, and your purse, or whatever, and you leave the house, leave the store, and then next thing you know, a month passes, right? Now remember, you apply for a credit card at that counter. That's what happened. That's how you get the 15, 25% off discount, right? And they're gonna mail you usually your first bill or email you, right? Here's another fun fact: 99% of people in America, or 98%, check their physical mail. 45% open that mail. Okay. So basically, what happens is that credit card company shoots you your first bill or statement in that mail. Now, it comes looking like a regular, some junk mail, and you don't open it up. You throw it in the trash. Now, you forgot because, life gets busy. You're doing things, doing what you got to do, living life, being great. You forgot you got 25% off of that purchase you made, right? And now you have to pay that credit card. And next thing you know, 2 or 3 months pass and you ain't paid it. Now I got late payment. So you call me up, say, hey, I want to buy a house. Meanwhile, you think that everything's cool. I pull that credit report and I see 30 days, 60 days, 90 days late. Maya, what is this credit card with TJ Maxx? Oh, I went there to buy these blouses and these boots and these purses. Now I got to decline you because I got lates within the past 12 months on the credit report. All because you want to save 25%. Don't do it. Don't do it. Please don't do it. Now, if you want to say that 25%, just do this for me. Please just make sure that you check your mail and check your email. And when those bills come, you pay them people their money,
Yeah.
right? Because otherwise, you're going to be homeless in that nice blouse, and those boots, instead of having a house,
You're
right?
gonna be a fashionable homeless person.
Fashionable homeless person, looking good. So yeah, just make sure you pay those people on time their money. Give them their money.
Okay.
That's it. That's it.
Well, I want it. We got some questions. We got a few questions. And also because a lot of y'all, I don't know if you know our story or not. I say it often, but I purchased my first home with Sean. And during that time, I was working in corporate. I was making a whole lot of money, but I hated my job. I hated my job. It was high paying. I was a high wage earner, whatever. And I was in the middle of purchasing a home or being approved, and I wanted to quit. And Sean was like, "No, do not quit." So if you don't mind getting into that a little bit, because a lot of people have that situation where they are approved and they go through the approval process and they're almost at the finish line, but then they quit their job. What happens then? How long do they have to recover? Like what happens? What can they do?
Well, I don't know why somebody would do that in the first place, but
Mm-hmm.
once again, you need to keep your job through funding and the note date, right? It has to happen. You're going to verify the employment up until the day that you sign on the dotted line. Now, let's just say something happens, right, and you get fired day before closing. Unfortunate, but I've seen it happen. Now, the way to get around that would be is, of course, you get another job instantly. Of course, easier said than done, but the job needs to have equivalent pay or better to what you're doing right now. So let me give you an example. Let's just say I was working at Walmart and day before closing, I got fired. Then I go to Target as an example. I got a job there paying the same amount of wage. The problem is I would have to wait until I probably get one paycheck stub in most cases before I can close. One stub. Now, here's another catch. Sometimes we may be able to talk the lender into pushing the pay stub to what they call a prior to investor condition. Yeah, so basically that's what you don't want to do. You don't want to quit your job if at all possible. You want to make sure that you hold that job till closing afterwards, right? Um, in the event, once again, something does happen, we want to have something lined up as quick as possible if we want to keep the same contract on the home that you're trying to buy. Right now, once again, if you do have that problem or something happens, you lose your job, right before closing, try to get another one, and then you can talk your lender into making that one pay stub what they call a prior to investor condition. So they'll let you fund the loan with maybe an offer letter or what they call a written verification of employment from the payroll or HR department, right? And then wait for the pay stub until after closing. Sometimes they want you to wait to have a full pay cycle on a pay stub before they'll fund the loan out. But it's unfortunate, but it could happen.
Okay. And then we have just one more question. So missed payments on a prior mortgage that's showing up on a credit report. Can you go in a little bit of detail when it comes to that? And if you do pull someone's credit report and you see a missed payment or two or three or what have you,
Mhm.
is there any hope for them to get approved?
Yes, is that's a yes. So okay, so it depends upon a couple of different factors. Number one, how recent was this? The past 6 months, the past 12 months, right? Recency is extremely important, right? Number two, what kind of loan am I doing? And how is the rest of the credit profile? Lates on mortgages, any other kind of loan, any kind of active debt, a late payment could really kick you about 100 points or more sometimes,
Mhm.
right? So
Mhm.
it can throw you completely out. Right now, in the event you have a strong credit profile, let's use an example here. You've got a strong credit profile. Basically, everything else you paid on time has been paid on time for a very, very long time, right? And you have a super high credit score, but you had one late a few months ago, and it just rocked you, right? That may have cost you 100 points, possibly. May have cost you less, right? But on the lending side, when it comes to the mortgage, let's say you had a mortgage, like you said, and you paid it late. It depends on what kind of loan that I'm doing right now for you. For example, if I'm doing an FHA mortgage again for you, and the rest of your credit profile is strong, but you have that late payment, I might get an automated approval. If the rest of the file is strong, it may give me an AUS approval and be okay. Okay. Now, in the event I don't, I think for FHA you can have, I think, one late in the past 12 months, but none in the past 6 months. Now, for VA, it's the same. They want to see a clean 12-month payment history. Uh, if you have an excuse as to why it happened, that could help you, right? But let me tell you this, financial irresponsibility is not an excuse. I forgot, it's not an excuse. I got
Mm,
busy, it's not an excuse. Not going
mm.
to take it, right? Somebody may be in the hospital, somebody better got shot, something better happened that was out of your control. It won't happen again.
Yeah.
That's an excuse. But you
Mhm.
forgot, or you didn't have the money because things were tight. That's a bad answer anyway.
I do have a question though. As a credit person, I do have people that have missed payments and they want me to flip it. So with your flip it, for those that don't know, meaning overturn the missed payment from late to current, 60 days late to current, 30 days late, 90 days late, so on and so forth to
Uh huh.
current. And to be honest with you, a lot of times if it's too recent, meeting within the past 12 months or so, and there's too many of them, the best thing for me to do for your credit, as far as that's concerned, is to remove the whole account. Now, if let's say a client comes to me first and I see that I've resolved the issue by either flipping the missed payment or removing the account and then send them over to you, will you be able to approve it because it's off their credit report?
In most cases, yes, except for a mortgage installment account. Okay. So for a mortgage loan, uh, they may they may ask for what they call a verification of mortgage or a VOM. So that means
Mm-hmm.
they got to call the other lender and say, "Hey, did Tamiya pay her mortgage on time for the past 12 months? Send me a report,"
Mm-hmm.
right? Directly from them. And then it'll say, "Yeah, she missed 17 payments over the past 2 years," right? Then I'm like, "You got to go. That's not going to work for me," right? Now, let's say Tamiya has a car payment, right? And she got the lates off of the credit report. That that is fine in itself. Okay, that's fine in itself, because we're not going to call. We're going to go off what the credit report says. We're not going to call the Toyota Motor Credit and say, "Hey, did Maya pay her payment on time for the past 12 months?" We're going to go off of the credit report, and that should do it.
And what if a person never had a mortgage payment but got evicted from apartments and it's resolved on their credit report, meaning it's closed or what have you, it's zeroed out? Will that hinder them from getting approved for a mortgage? Or,
No,
okay, an
not at
eviction.
all. The zeroed out collection. Usually, when evictions show up on the credit report, the collection, the name of the apartment complex shows on there. The underwriter reserves the right to ask about it. They
Mm-hmm.
usually don't because it's zeroed out, right? They don't really care. Now, what could happen is, depending upon the rest of your credit profile and your actual score, the lender can ask for a verification of rent. Okay, and if verification of rent says you've been late or evicted on the VOR, then that could decline your loan, right? But once again, if you know you have an eviction or these issues, you want to make sure the rest of your credit profile is somewhat decent and clean. And we could do an automated approval as opposed to a manual underwrite, right? And then um, the eviction won't be really much of an issue.
Well, that's all the questions that we have. So we're going to wrap this up. Thank you so much, Sean, again, for having these weekly lives with us. So, in the meantime, guys, be sure to leave your questions, be sure to leave a comment, like, share, subscribe, schedule your consultations with Sean, schedule your consultation for credit repair if needed. Sean may even send you over to me, or Sean may say you're good to go. But whatever it is, make sure you do something about it. Stop guessing. Stop listening to Ray Ray and them and their situations, because those situations are not your situations. Okay.
Right.
So
Exactly.
that's, yeah. But I know we'll probably get a lot of feedback though, Sean, when it comes to this topic, because it's a common thing. It's a common thing, and people don't know what to do after they've been denied and they think all hope is lost. I've had plenty of clients do that where they just give up and then they start trying to get an apartment or something like that, and it kind of just goes downhill from there. So,
Right.
I know this will help a lot of people. But in the meantime, guys, I'm gonna let you guys go. Um, we wish you the best of luck on your credit journey. Sean, I'll let you take us out.
Awesome. Thank you guys for tuning in. Keep watching. There'll be more data being dumped your way. Once again, if you have questions, give me a shout, give me a call, shoot me an email. Info will be below. Or just call me or Tamiya if you have any questions or concerns, have a scenario, something you want to go through with us, give us a call. We'll love to take care of you.